Welcome to today's webcast, Data Analytics in Life Insurance, Underwriting, and the Associated Risks. Before we begin, I'd like to cover a few housekeeping items. To receive a copy of today's presentation, please send a request to reply@riskreg.com. To ask a question during the meeting, type your inquiry into the Q&A panel to the right of your screen. We will respond to all questions after the session unless time permits at the end of the session. To answer polling questions, click on the radio button to the left of your desired response. Then click Submit to record your response. For technical assistance, click the Help widget at the bottom of your screen. Today's presentation will be recorded. In order to qualify for CRE credit for attending today's event, log into the webcast with your first and last name and email address. Remain on the webcast for a minimum of 50 minutes. Participate in the polling question, 80% response required. To answer a polling question, click on the radio button to the left of your desired response, then click the Submit button to record your answer. You do not need to have the correct answer, but must participate to receive credit. Complete the course participant survey. For attendees participating in a group, designate one proctor to log in as an individual on behalf of the group. Then complete and submit the group assignment form within 24 hours of the event conclusion. The form can be downloaded from the resource list on the right of your screen. Complete and submit the course participant survey. The form can be accessed from the resource list to the right of your screen. One CRE credit will be issued to eligible participants within 30 days. RRC will not issue credit if all criteria are not met without exception. I would now like to turn the call over to Jennifer Kelly, who will kick off today's program. Jennifer, the floor is yours.
Thank you, Allison. Our first presenter is Tricia Matson. Tricia is a partner at RRC whose key areas of expertise include financial reporting, reserving, ERM, internal capital models, and regulatory requirements. Tricia was a former chair and is a current member of several American Academy of Actuary committees. She has authored and spoken on various financial reporting and risk management topics. Our second presenter is Andy Raris. Andy is an actuarial manager at RRC whose key areas of expertise include term, whole variable, and universal life insurance products, and fixed, variable, deferred and immediate annuities, and long-term care. He has participated on several SOA committees and is a frequent speaker at industry conferences. I'm now going to turn the presentation over to Tricia to go over the objectives of the webcast. Tricia?
Thanks, Jennifer. Our objectives today are to give some background on accelerated underwriting. I'm sure we have a mix of backgrounds on the call today, so just to be sure we're on the same page in terms of what it is. We worked with the Society of Actuaries on a Delphi study. I'm going to explain what that is, related to accelerated underwriting, and found there was a lot of interesting findings from that. So we'll go through some of those. We'll talk about some of the risks that may arise related to these accelerated underwriting programs, and then how those might be evaluated as part of the regulatory review process, either through exam or analysis. So to start off here, we've got our first polling question, and I'm going to move a little bit slowly because I know from experience that it's important to allow people time to complete these. So we'd like to know our audience a little bit, so please answer the polling question in terms of which of the following most closely describes your current role: financial examiner, data analyst or specialist, a market regulation examiner, an actuary, or other. So we'll just give folks a second to complete that. And okay, we're getting closer now. I just want to make sure folks have time. And just a reminder, I know we said this already, but make sure that you answer 4 of these if you want to get the continuing ed credit. Okay, it looks like the responses are slowing down here. So last chance. Okay. Oh, whoops, I missed my polling question answers. Here we go. So it looks like we have a lot of financial examiners on the line today, so that's great, and then a mix of other backgrounds. So I'm sure there's something in this material for everybody. So you can let us know. We've got some questions at the end to find out whether you thought that was true or not. So I'll just start with a little bit of background here, nothing too fancy, but underwriting is there's different types of this out in the marketplace today. Accelerated is one of the newer types of underwriting. And, a traditional underwriting, as folks I'm sure are aware, typically involves collection of fluids. It involves looking at an intending physician statement. There's typically a pretty complicated application and a lot of medical information collected. And because of that, it can create a barrier for some customers. They just don't want to go through this because it's complicated and it takes a long time. Accelerated underwriting, the goal really is to kind of get the same outcome. So the reason that under traditional underwriting all this data is collected about someone's medical conditions, et cetera, is to be able to understand what their mortality profile is, and then that's used to put them into a rating class and price their policy. The goal of accelerated underwriting is to basically kind of get to the same understanding of their mortality profile, but without the same level of work on both sides. There's not as much that needs to be collected from the customer, and there's not as much that has to be done on the side of the insurance company, thereby reducing the cost. It is true that the pricing could be higher. It depends on the program, how sophisticated it is, how long it's been in place, but really the goal is to kind of get you the same outcome with less collected from the consumer information and definitely eliminating fluids. And I say those things because I wanted to contrast with simplified underwriting. And the difference there is that there's a lot less collection of information, so no collection of fluids, but it's by design going to have a worse mortality profile. So unlike accelerated, the goal in simplified is not to get to that same ability to classify the mortality risk. It's known that the mortality will be higher because we're not collecting that information. And so before I move on to the next polling question, just to set the stage a little bit for folks in terms of this Delphi study. So I did just want to explain that a Delphi study is a survey of experts in which you kind of ask questions a few times in a row, and all the participants get the benefit of what other participants said. And the idea is that as you go through those iterations, you start to converge on a common answer. And what's nice about a Delphi study, especially for something like accelerated underwriting, is that there's a lot of unknown. Depending on the company, there's some companies that have been doing it for a good amount of time, but it is newer. And there's not a lot of data in terms of what it's going to mean for mortality outcomes. And so using something like a Delphi study, you can grab experts that know a lot about these programs and get their judgment to inform the research, as opposed to having to use hard data to inform the research. So we did that, and our comments today will include comments about what those experts thought in aggregate. And just so that you're aware of kind of the background generally of these experts, we did have folks with background in underwriting, understanding of predictive analytics, which are frequently used in accelerated programs, understanding sort of how you analyze mortality experience and data, mortality assumption setting, folks with expertise in credibility and credibility theory, and then also folks that kind of had a little bit more of practical application knowledge. They're sort of the business folks that are using these programs to try to improve the experience for the customer. So with that, here we'll go to our next polling question. So wondering for our group on the phone here whether you currently regulate a life insurer that uses accelerated underwriting. So our options here are yes, I regulate many of these types of companies. Yes, there's one or a couple companies that I regulate that use accelerated underwriting. No, but I might do that soon, either because I'm changing the companies that I regulate, or maybe some of the companies that you regulate are starting to adopt accelerated underwriting techniques. No, and I don't plan to soon, or I'm just not sure. Maybe you haven't really looked at this closely, and so you don't actually know if the companies that you're regulating have these programs. So again, I'd like to be sure that folks have time to complete this. So I'm just going to pause momentarily. This one's moving a little bit faster than the first one, so it seems like we're getting into the groove. Okay, last chance, last call to complete the question. Okay, and somehow I managed to skip it every time here. Sorry, guys. Okay, so looks like we have a mix. So, the largest percentage not being sure, which you may not know. I mean, that's part of, I think, what the goal is with these programs is companies want it to kind of look seamless. It's, behind the scenes. But obviously we have some folks on the line here as well who have, looked at this or are aware that the companies that they regulate are using these programs. Okay, so with that, I will turn it over to Andy to pick up from here.
Hi, and good afternoon. I'm glad that all of you could make the webcast. Just following up on what Tricia was just saying, we notice in recent exams that the topic of accelerated underwriting comes up more and more frequently. So I would say over the last, say, 2 or 3 exams that I've been managing, that topic has been in our actual report. So it is becoming more prevalent, even though there's still a fair number of people who may not even realize that companies are doing it. I'll cover this, the numbers in the slide in a second, but accelerated underwriting is just one way in life insurance underwriting, and that's not necessarily mutually exclusive from the traditional underwriting pathway, where there's medical exams and fluids collected in labs and all sorts of things like that. Still for some applicants, the traditional pathway will continue to be the most prudent one. But that being said, our experts in the Delphi study were asked the question, what percentage of applications would be submitted through accelerated underwriting? And you'll see that there's a few slides like this throughout the presentation in which the answers show sort of the minimum response. In this case, there was someone who thought that it might be 20% within 5 years. The maximum response, which would be, most of them being submitted through accelerated underwriting of 95%. But on average, they felt that about a little more than half would be submitted through accelerated underwriting in 5 years. But I find this to be even more telling. It's just in 10 years, the average goes up to 80%. And honestly, this study is a couple of years old, so we're sort of 2 years into the 10 years. So it's pretty eye-opening because I don't know that I knew that before I saw these results. So accelerated underwriting might not work in all cases. And so if you think about where questions are asked now, there could be situations where either because of a medical test or a question that you might answer on a questionnaire when the paramedical comes to your house may not be able to be easily discerned through some of the techniques for accelerated underwriting. So for example, for complex or unusual medical history, a person might be more easily determine which medical history is most significant and what additional details are more relevant. Some of the panel experts argued that this might be short-sighted and that maybe an automated process can be trained, i.e. Artificial intelligence, with the same precedents and make the same decisions, but also do that without bias, because obviously with humans involved, there's always some element of bias. Just as an example, accelerated underwriting might be riskier when it's applied to a target market or pools of applicants that have a high prevalence of smoking, obesity, and diabetes, all of which might be hard to tell by accelerated underwriting techniques. To the extent that accelerated programs exist more broadly at lower face amounts, then you might notice that the aggregate risk profile might be similar to what exists for traditional underwriting. So there's a lot of different facets of this that will impact how many people can go through this and how effective a program might be. So these slides are, I find, to be very interesting. So let me sort of ground you here on these slides. So these are a list of accelerated data elements that companies are using now to some degree or another. And the panelists were asked which of these are most important which have medium importance, and which have low importance. And so if we look way to the left, we see the RX check or the prescription check, and you can see that there's a high percentage of the panelists who feel like currently this is very important. And on the opposite side, to the right side, you'll see that facial analytics, although it might be used by some companies, at this point in time, they felt that that was probably of less importance. And then sort of everywhere in between. But you see sort of a natural progression across the graph. A lot of red, high importance to the left, a lot of dark blue, lesser importance to the right, and sort of medium importance going up through the middle. So it follows a nice little path. So I'm going to actually flip back and forth between these a little bit. So one of the things I want to bring your attention to is the RX check on the left, the telephone interview, which still has high importance, the online questionnaire, which is somewhat in the middle. You can see that that's not very high importance rated, at least by the panelists. Artificial intelligence has almost no importance, very low importance, and then also the electronic health records. So I'm going to move to the next slide and just kind of imagine how it changes. So now we flip this over, you can see that the chart looks way less progressive. You don't see as many red up in the upper left-hand corner, as many dark blue in the lower right-hand corner, and then the middle looks all over the place. But a few things I'll bring to your attention. So the panelists still feel that the RX check is going to be important. So that makes sense. That's something that if you check what prescriptions people are taking, and that's easily and readily available, oftentimes it gives you tips as to what that person might have for impairments. And of course, this whole webcast has to do with discrimination, and so whether that should be used or not is a question mark. But if you then look at the telephone interviews, you see it's way less important on this slide than it was on the last slide. Again, moving over to online questionnaire, you see much higher importance 10 years from now than 10 years ago, much smaller. And then artificial intelligence, much more important. But look at electronic health records. That is just so much more important, or at least by the standards of the panelists, than it was 10 years ago. So I just think it's interesting to look at this. And then there could be other ones that we haven't anticipated, certainly, and some that have come up in the last couple of years. So, just take a look at that on your own. Let's see. Oh, I guess we have a polling question. It's a polling question number 3. Which data element used or potentially to be used by life insurers do you think causes the greatest potential for risk? A, none of our concern or risk. B, credit data. C, social media. D, demographic data. E, artificial intelligence. F, facial analytics. Or G, other. And I'll give you a little while to answer those, but make sure that once you do that you push your submit button. I'm going to move forward to see how it's going, and looks like there's a fair amount of response. So what we can see here is it's pretty spread out, but credit data, which is something that it's not a new topic certainly for all of us. Social media is certainly a new one, but it's something that even for job applications, we're seeing a huge impact from companies using that. Demographic data, a little bit smaller, artificial intelligence, and facial analytics. So pretty spread out, but credit data being sort of the winner in this case. Okay, so one of the things that's important for an AUW program are what kinds of risk indicators are the companies using so that they have hopefully a pretty robust and efficient and accurate program. So going through some of these, to the extent that you're only using say smaller number of data sources, the ones that we covered a few minutes ago, or maybe slow to adopt electronic health records, then that might be a problem. The Sentinel Effect, take that into consideration. That's when, human behavior improves when they know someone's watching. So, for example, less lying when you know a medical exam is coming and more lying when it isn't. Let's see, they might use only paramedical or paper application for medical data. Again, they might only use, say, the RX and the credit score and nothing else. And those are sort of the only gatekeepers for accelerated underwriting. Perhaps they don't use random holdouts, which helps you identify the difference in perceived mortality and then actual mortality in the post-issue checking of someone who could have gone through accelerated underwriting versus someone who actually had the full traditional underwriting. Let's see, what else? Perhaps using just industry data instead of your own company or market data. Data can have a big impact if you have poor data quality in the way that you pull that together. You may have a model, but it may not be very predictive, and so validation of that model is going to be important. Your model might be focused on cost savings and increasing market share without really considering what the profitability of what you're doing. So that may also result in increased mortality, which obviously would decrease profitability. A feedback loop is important. You have to be considering all of these and what you're doing and seeing how the risk that you're assuming for accelerated underwriting matches the actual risk that happens in your experience. Let's see. So some of the mortality risks that might be more difficult to capture by accelerated underwriting. So there certainly are many risks that are already directly identified with traditional underwriting process that are inferred or otherwise built into the data elements based on what an underwriter might perceive from traditional methods. This, of course, is all predicated on the assumption that the client has accurate, truthful self-disclosure on the medical history questionnaire. But to the extent that the company is already getting high levels of accurate disclosure, then specific requirements around this may not help very much going forward. I guess in general, to the extent that there's misrepresented or an undiagnosed condition that might be discovered typically through an APS, something like cholesterol, then missing that is going to have an impact. So to the extent that you've priced that into your cost of mortality, then that's fine. But if you're sort of ignoring that, that's a problem. Yeah.
And I was just going to add, Andy, that you showed on some of your prior slides that as of today, some of the very, very common sources of data that companies use in their accelerated programs are, prescription drug data and they might get data from the Medical Information Bureau, for example. So, like if you sort of compare that to what you're talking about now, like things that someone's going to take a regular prescription drug for is easy to find with accelerated underwriting because you have information. Typically, most programs use prescription drug data, and so you would identify that condition based on their use of that prescription drug. But I think a lot of the things that you were showing on the slide are things that you wouldn't see in the prescription drug check, you wouldn't see from the Medical Information Bureau. They're things that, if you had done a medical exam, you would have seen, but a lot of the data sources that are used now don't identify these things. I mean, as accelerated underwriting gets better, then maybe these will be easier to find. But anyway, it kind of lines up. I just wanted to point out it aligns with like what the source of the data is. If the source of the data, again, mainly RX, would show a condition, then you probably would catch it. And if that data doesn't, then it's going to be much harder to catch.
Right, and that actually reminds me is if you consider younger applicants where they may have medical conditions that are undiagnosed, and maybe these younger applicants don't get regular medical care, those wouldn't necessarily be caught by an RX check. It would be more difficult to identify, unless, of course, the younger applicant discloses that on the application. So let's see here. Okay, so this slide has to do with, again, the panelists were asked, what is the additional mortality for accelerated business compared to traditional underwriting? What was the overall increase in mortality? So some obviously felt that there would actually be a decrease. Some thought that it might be as much as high as 25%, but on average it was 4%. So that doesn't seem crazy, but I would say that again, that's an average, and if you think about the the accelerated underwriting programs, they can be very good or very bad, and so I think the variability would be quite large. You know, one consideration with respect to this is that the mortality impact on accelerated programs will have on the portion of the business it's not accelerated. So that's not something that you would think, but that would obviously be true, because for that remaining business, that will now probably consist of a larger percentage of marginally healthy lives, because more of the healthy lives are successfully getting through the accelerated underwriting process. At any rate, I would say that it's going to increase it significantly, or not immaterially, overall for that business not going through accelerated underwriting. You know, companies that have good monitoring practices in place with appropriate risk measure controls should experience better mortality than companies using AUW, but not necessarily better than traditionally underwritten business. It really depends, as I said, on the design of the program. You would expect that the higher the acceleration rate, the more the mortality difference will be off, because, and particularly early on, as people are monitoring that experience and then adjusting how they do their accelerated underwriting algorithms. You know, the more data, as we talked about, the better, and the more sophisticated the model is, the better. And I would expect that over time, that will become closer to the traditionally underwritten mortality. I would say overall, mortality is going to go up. Maybe it'll be 4%, maybe it'll be more, but right now it's hard to say precisely because we don't really have a large sample size. So let's see here, this is the impact on the mortality curve and grading. And the question was, how many years do they think that accelerated underwriting mortality would grade into traditional underwriting mortality? It's pretty varied here, as you can see. So, you know, the average is even 14 years, which is quite long, but, you know, 0 years to 50 years, it's just so wide. So what that, of course, would argue for that because it's a little less understood, having a bigger margin will probably make more sense. It also doesn't consider, it's not considered in this question about the slope as opposed to the level of importance, of the level, mortality level. The selection period that's seen with traditional underwriting might be muted with less direct medical data, and you might see something different with the slope with respect to accelerated underwriting. I think I'm turning this over to Tricia now.
Yes, correct. Yeah, and just I'm going to make one more quick comment related to your last slide. We don't have to go back there, but okay. I just found it interesting that, you know, there was such a wide range of views from experts on, you know, like what the mortality is going to look like. And, you know, there's not, I mean, there is a limited number of experts. I mean, even within a company that's doing this, you know, there's a lot of people that are not experts in it. And so all that says to me is like, it's something that if a company has this program, and we're going to touch on the risk profile and ways we expect companies to be, you know, mitigating those risks, but it just says that, you know, the amount of uncertainty is significant. And so companies need to, you know, make sure that they're either like, you know, evaluating that closely and able to kind of get a good handle on it for their business, or if they can't in the short term, you know, like put a margin on it, both in terms of how they price and how they reserve, because they're, you know, it is not known yet exactly what this is going to do to mortality risk. So with that comment, I did want to touch, Andy mentioned the Sentinel Effect, but I wanted to just, you know, touch on this in a bit more detail. I think accelerated underwriting was the first time I had really heard of the Sentinel Effect. I don't know if that says something negative about me or if that's common, but this is a new term for me as I started to understand accelerated underwriting better. So what happens, of course, is that, people self-select, right? They do things differently when they know someone's going to check on them versus when they're not going to check on them. So what happens in an accelerated underwriting program is that, people, if they know they're not going to be tested, they're not going to have fluids drawn and not go through a medical exam, they are more likely to choose that path. And they're, more likely, and if they have some condition, they're more likely to hide it if they don't think someone's going to check for it. So that is, the big risk that goes with an accelerated program when you're not collecting the same amount of data. And so what do companies do to counteract that? Well, again, the idea is in theory that if you collect the right set of new data, that new data will give you, equally good, and, I'm making quotes with my fingers, equally good information about their mortality risk profile. So that's kind of step one. But there's other things that companies do to try to see if it's working. So they do that, in other words, collect other data that they think will get to the same answer. But as Andy was just talking about, that other data isn't always good enough. And so this concept of a random holdout, which Andy also touched on earlier, is to take some of the individuals that would have gone through the accelerated program and run them through full underwriting to see what the outcome looks like. In other words, are you finding that when you pull a random holdout away from accelerated and put them into full underwriting, is the outcome worse? And again, you need to do that with enough people that you can actually kind of then compare. You have credible data to compare. But random holdouts are very important to evaluate whether the program is working or if it's, skewing things so that the risk is much higher. And so, most companies that I've seen with programs like this are doing random holdouts as a way to test. And it's, kind of the most direct test. But other things to do is to just look at the results after the underwriting has been done, the accelerated underwriting. So after issuing the policy, you may be able to look at the attending physician statements, looking at changes in the mix of business, monitoring whether there's something unusual in terms of the mix of business coming from individual agents. Because, again, the agent is sort of the key to what the consumer knows about the program. And so if you have situations where specific agents or agencies are bringing an unusually large number of accelerated cases, it could be because they're working with their customers to try to improve outcomes on the underwriting. So those are some of the approaches that companies are using to try to offset this Sentinel effect. And we're going to talk more a little bit later about the controls that companies may have associated with risks on accelerated underwriting. So with that, I'm going to switch topics a little bit. So the SOA study was very focused on, what is being done in accelerated underwriting, what are the data elements being used, and then what does that likely mean in terms of both mix of business, kind of customer experience, and mortality. Mortality was definitely a big component of that survey. The SOA survey didn't really deal with another big and important risk with accelerated underwriting, namely potential for discrimination. And obviously there's been a lot of activity at the NAIC and, across various states with, making sure that these programs are not resulting in unintended discrimination. So, as folks I'm sure already know, the program should not be discriminating either intentionally or unintentionally on the basis of race, religion, or sexual orientation. And then depending on, individual state laws, there's other protected classes that, need to be considered as part of these programs. There is not a lot of very specific guidance out yet that talks about, restrictions or considerations related to accelerated underwriting. A couple that I am familiar with so far that I thought I'd comment on in this call. And I know we have some folks from these states on, so feel free to type in the Q&A if you have anything to correct or add. The New York Department of Financial Services did issue a circular letter on this in 2019. It's circular letter number 1. And so that specifically relates to use of external data. It does carve out a couple of the more common and expected types of data, namely use of the Medical Information Bureau, motor vehicle records, and criminal records. But aside from those carve-outs, it does indicate, as you would expect, that the insurer shouldn't use the external data or algorithms unless the insurer can establish that it does not use and is not based on in any way race, color, creed, national origin, status as a victim of domestic violence, past unlawful travel, or sexual orientation. Very specific guidance there that, not only shouldn't you kind of directly use any protected class as a basis for underwriting, but you have to establish that it's not based in any way on those criteria. And then the other big component of the New York Circular Letter relates to disclosure. And it does require that the reason for any declination, limitation, rate differential, or any other adverse underwriting decision has to include, so that would be provided to the insured, and then it has to include details about the information upon which the decision was based. If you were declined, it has to be explained what data was the basis for that declination. And maybe I'll comment quickly in there. I know we got a question in the Q&A about, the availability of this data. So as part of the process to go through accelerated underwriting, the consumer would be providing an approval for the insurer to get access to their data. And if they don't provide that, then the insurer couldn't access that data. That is a requirement in order to go through the accelerated process. And then on Washington's a little earlier in the process here, but there's a proposed ban on the use of credit data for life insurance as well as auto, boat, homeowners, renters. The comment period for that, I know, ends on October 26th, and there's a stakeholder meeting on the 27th, so that's a work in progress. And then the last comment I'll just quickly make here before I move on to the next page is there's kind of two things to think about in terms of discrimination. One is, unintentional discrimination against one of these protected classes. So that one is more straightforward. Making sure you're not doing it is not straightforward, but of course, the industry does not intend to do that. Are well aware that that's prohibited. The second, though, is sort of how much it's okay or not to discriminate against non-protected classes, right? So, at what point is the differential in mortality kind of acceptable? So, I used a simple example here, like how comfortable are we that, if you buy more unhealthy food, you might have to pay more for life insurance versus not. It's a little bit of a different question and, certainly a secondary one, but obviously underwriting involves a type of risk classification or quote unquote discrimination. That's part of the point. And just the question is which categories of that or which risk classes do we think are appropriate ones to segment by and which ones are not appropriate? So to just explain this in a little bit simpler way, I created this very simple and very extreme example to try to highlight what could happen unintentionally with an accelerated underwriting program. And I do want to make it clear that it is viciously oversimplified. So I don't want to leave anyone with the impression that, this represents any company's accelerated underwriting program. But I think, again, making it simple kind of brings the issue a little bit to light, especially if you're not an expert in it. So in this case study, we have two individuals that have applied for life insurance, Sally and Sal. I have my wonderful artist rendering of Sally and Sal on the left there. And so what happens with these two individuals if we run them through full underwriting versus running them through accelerated underwriting? So on the full underwriting, what we see, because we collect all kinds of medical data and we do an exam, they both have low blood pressure, neither of them smokes, neither has a family history of disease, and all the fluids were normal. So with that, actual data that we've collected on the specific individuals, they both get rated preferred. Now let's move them both through an accelerated program. So we don't collect actual, fluids, we don't take blood pressure, no medical exam. And what we do know, though, from our data that we use in our predictive model is that Sally lives in Birmingham, Alabama, and she purchases tobacco products, and she belongs to Weight Watchers. We have all that data because we've collected it. And then Sal lives in Minneapolis. He does not purchase tobacco, and he has a gym membership. And so, we run our algorithm, and again, it's oversimplified, but based on these fact patterns, I'll just also share one more fact that Birmingham, Alabama has the highest rate of hypertension in the U.S., and Minneapolis has the lowest. So those are like correlating variables for hypertension. So as a result of that, we end up rating Sally as standard and Sal as preferred. We'll dig a little deeper. So this is what our algorithm knew, from the data we were able to collect. If we knew these people in person, it actually turns out that Sally buys tobacco products for her mother. So she's actually not a smoker. Again, we would have learned that if we did full underwriting. She appears to be a smoker based on the data, but actually is not. And smoking, in addition to a host of things, does correlate with high blood pressure. And Sally actually is a runner, but she doesn't have a gym membership, so we did not pick up her physical activity in our algorithmic model. And then Sal, although he has a gym membership, doesn't actually go to the gym. So anyway, the point of the example is, is this okay? Like, is what we've done reasonable based on the data? And if we did a random holdout to test this, we would find that the outcome for Sally was inappropriate. So again, that's why those random holdouts are so important. And then just the last thing I'll say, even if we sort of say, well, it's a model and it's going to get it right 95% of the time, but maybe we have these few outliers and, Sally still got, standard insurance rates. What if we found that these two came from very different ethnic backgrounds or different, they had different religious preferences, et cetera. So then how do we feel about the outcome of this accelerated underwriting? So again, a little food for thought there. It's, our simple example to show that this is hard. I mean, it's hard. And the last thing I'll say is the insurers, they can only collect data on race optionally. They can't require the applicants to give them data on race. So that makes it even harder to look for cases where you might inadvertently be discriminating. Okay, so this next slide talks a little bit more about measuring the performance of the program. And some of this we talked about already because some of this does relate to kind of is the mortality outcome what you expected based on the program that you developed, doing things like the random holdouts or monitoring the mortality, post-issue. Other things that are important to look at are just looking at the mortality experience overall and, not necessarily comparing it to a full underwriting program. It depends on how the insurer designed their program. Some design it anticipating that they'll have a little bit higher mortality, but they'll offset that with lower expense because they won't have to do so much underwriting, with medical exams, et cetera. But how does it look compared to what you expected? And then, what are the acceptance percentages looking like? What do they look like by subset of the population? How does the mix of business compare to what you had before or what you expected? So just ensuring that the company using this is doing those things. I know there are some smaller companies that use outside consultants for either data or support in the accelerated underwriting, which of course is fine as long as there's enough knowledge inside the company's walls to be able to, track the experience and make sure it's doing what is expected, versus like kind of more of a blind reliance on an outside party. So a few other things that are important to keep an eye on, and again, these relate not necessarily just to like risks that we might be concerned about in regulating companies, but also, obviously companies want their programs to be successful. They want the customers to, have a good experience. They want to get access to new customers. So, just watching if you have like unexpected lapses, unexpected early claims, checking how fast you can get these products out. One of the main goals is to make this easier on the customer, and if it still takes almost as long to get a product out, then it's probably not meeting the expectations that you set up from the get-go. And then, again, I talked about some of the distribution considerations, but distribution by, risk class, smoking status, BMI, et cetera, the more kind of ways to dice that data, the more you would learn about where you might have gaps in your ability to use the accelerated program to find specific conditions. So here we go back to the Delphi study, but this is a little bit of a different view. Again, something that I think a lot of the participants in accelerated underwriting are looking to do is attract new customers. And so this slide just shows what our experts thought would occur in terms of brand new customers that were previously like underinsured or uninsured, brand new customers that we would bring in because we now offer an accelerated program. And then based on that, what their mortality looks like relative to what we would expect for more traditional underwriting. So you can see the ranges are pretty wide, but there's certainly some views that the extent of new customers would be pretty significant. So again, I know there's some things that are challenging with these programs, but another big positive here is that there are people that otherwise might not have insurance, that because this is a much easier process now, might become insured, which obviously is helpful from a financial security perspective. And then the last sort of technical slide I'm going to cover before I go to one more polling question is just looking at, we've talked about a lot of these, but this is also something that, I know we have done and will continue to do in terms of looking at risks on an exam. And so, if a company has a significant accelerated underwriting program, there may be specific risks that are identified for evaluation during, the early phases of the exam. And so we tried to highlight some samples of what, you might see as you look at a company with a significant program. So one would be that they're pricing the business aggressively, especially if they're new to it, they don't have a lot of experience. I think it's easy to do that. I hear often kind of a almost flippant answer to questions about the pricing to say, well, there might be higher mortality, but we're going to offset that with expense savings, but not necessarily having the analysis to back that up, more thinking that's going to be true because it was true for other companies. So, there's a probably moderate to high likelihood that there could be some aggressive pricing, especially for a new program. And if that were the case, that could be very severe. The next one I talked about, some companies don't have sufficient in-house expertise, and that could cause serious problems. If a consultant is, providing data or just helping with an algorithm, but there's not enough people inside the building that understand the program and what its implications are, that can create significant risk. The mortality assumptions might be too low because they're, especially again, early in the program, there's likely higher mortality. So that's another risk. Errors in the algorithms. Again, there was a reason on that sample slide we showed the AUW process is a little black box. Some of them are not. Some companies are, they can very easily share what the algorithm is doing, but there's others where it is more like a black box, so that's a significant risk. And then obviously we have the risk related to unintended discrimination and potential reputational risk and litigation exposure. So with that, I will move to our next polling question. So here we're wondering if anyone that's participating in our webinar today has actually evaluated risks associated with an accelerated underwriting program. And I did take a quick peek at the people that are on the phone today, and there's a few of you that I know have looked at this because we've done it together. So hopefully we'll get a few yeses here. So let us know if yes, you have, no, but you expect to have to do that soon, no, not sure if you will, or some other response. And we like to throw in other just in case there's something we didn't think of. And again, don't forget to hit the submit button when you've completed your answer. And again, I'm just going to give it a minute because I want to be sure that people have enough time. Okay, we still have a few more coming in. All right, we're very close. Last chance here. If you haven't done your polling question, please do and hit submit. Okay, so we have our responses here. And, okay, good. We did get a couple of yeses, so thank you. You know, so some folks aren't sure. Some expect to do it soon. And then I'm glad we had we do have a few others there, so thank you. Okay, with that, I will turn it over to Andy to continue to talk about our risks and how companies might be mitigating those. Just checking, Andy, that you're not on mute.
I am on mute. Thank you. I was saying I'm going to follow up on where Tricia laid out what the risks are with the controls around those risks, as well as some of the testing that you might do. So with respect to aggressive pricing, you know, one of the things that will be important is to do for the companies to do a review of their accelerated underwriting program and making sure that the pricing assumptions align well with what you're expecting. And so we would consider having an external expert consider that to be strong. The risk of not having in-house expertise, you could test that by using holdouts again. Another reason for why holdouts are pretty good, because you can kind of test what's happening with respect to the program and the expertise versus just doing the traditional method, and see to what extent there might be a lack of expertise. Some companies might say, and we've seen this, I've just seen this on a recent one where they said, well, you know, we're just going to include 5 to 10% more on the mortality, and that should cover it. And so, you know, in their defense, sometimes that control might seem fine, but early on, as Tricia just alluded to, it'd be really hard to know. So, you know, higher uncertainty, higher margin, but that needs to be monitored maybe even more closely than annual initially. So from a control perspective, we don't find that as being a particularly good control. With respect to whether there's errors in the algorithms, you know, just like with our cash flow testing models, we recommend having a formal validation process. In this case, if that can be done internally with internal ERM, that's fine, and as long as it's well documented and it's something that, you know, regulators could request if they know that a company is doing a lot more of that this year than the prior year, but certainly upon exam. And then with respect to unintended discrimination, you know, really, this is really kind of difficult. To the extent that you have the ability to know the information that you shouldn't be discriminating on, which isn't always the case, but to the extent that you do, you can measure your results versus those discriminatory variables and see what the correlation is. And if you can do that, then you'll know whether there is an unintended discrimination or not. And then with respect to sample testing, so one of the things that we might do in, say, phase 5 is, again, you know, review how your pricing assumptions compare to the actual experience, to industry data, because, you know, this company is not going to be working in a silo. There should be more and more industry experience that measures this, which is good. It's good for everybody. And then also the specifics of the program. What things have you done when you're looking at this going forward to make sure that that it's being handled correctly. This is testing. Again, we do this in regular exams with respect to the actuaries that are doing asset adequacy testing, are they qualified to do so? And so in this case, does the company have internal experts that are experienced and keeping up with their experience and becoming more and more qualified to weigh in on accelerated underwriting programs. With respect to mortality assumptions, again, using asset adequacy testing and mortality sensitivities, there's a lot you can be doing. Right now, you might see plus or minus 10% in mortality, and perhaps you might see, with and without mortality improvement. But with accelerated underwriting, and particularly with higher percentages of business being written that way, I think that there'll have to be a lot more substantive testing, and so that's something that we would be looking into. Doing back testing is always good, just kind of working backwards to see how the algorithm works. Right now, that might be a little difficult because your sample size is small, but going forward, certainly in the next 5 years, that's something that we as regulators could be asking the companies what they're doing relative to that to see how that applies retrospectively. And then finally, with respect to unintended discrimination, you can pull out samples and look at the data with respect to outcomes and then see if you are, again, assuming that the discriminatory variables, look to see if you are correlating in a positive way when you might not have been, but you shouldn't be. So these are all things that you could put on your risk matrix in phase 5 to do some of this testing. Let's see. So I got to just check. We have a few minutes, so I'll kind of go through these because we have to get to our last polling question. But with respect to we can see that there's a lot of new techniques out there, and that how companies are implementing the new techniques and practices will go a long way in predicting how well their program is and what kind of mortality outcomes that they might expect to see, and are they pricing for it accordingly. We do expect more and more techniques and data to be available over time, and so that should help. And then, as we talked about, the maturity of the program itself with their internal experts, with their actuaries, with their pricing actuaries, with underwriters is all going to play an important role, and then making sure that you're not, inadvertently discriminating based on classes that you should not be. As I've said before, traditional underwriting will still have a place, and I think that you'll see a mix for most companies. The goal is to sort of have similar mortality maybe 5 or 10 years from now with more and more information. Maybe that'll happen. One thing, again, finally, is to understand that for those companies that sort of are behind the curve in accelerated underwriting, they may end up getting just the people that are really higher risk and may have higher mortality and may lose market share. So I'm going to move on because I've sort of just about run out of time. So the last polling question is, did you learn something new today? Hopefully a lot, but perhaps maybe only a little. And then maybe you knew a little bit about this, or again, as Tricia said, other. Please make sure you hit the submit button for this, because this is the last question, and we want to make sure that you've answered at least 4 out of the 5. And we will run out of time, so I'm not sure that we're going to actually get to the questions that people have submitted, but rest assured that Tricia and I will take a look at those and respond to those questions. I think there's an opportunity for people to even submit questions afterwards. Certainly you can reach Tricia or I just by looking us up on the SOA directory and sending emails, or to the reply email that Allison and Jennifer mentioned at the beginning. So I'm going to move on to the thing. And so it does look like you learned a lot, so that's good. And it seems like at least a little. So that's really good to know. And I'll just pause for a second, see if Tricia has any ending comments with the last amount of time we have.
I'll just say that I just now did my best to try to answer questions in the Q&A box.
Oh, good.
Hopefully everybody got at least a decent answer to what they asked. And thank you so much for sending those in. We had some great questions.
Well, thanks, everybody.
Okay, a few reminders before we conclude. Please take a moment to participate in our attendee survey by following the link in the resource list to the right of your screen. We will respond to any additional questions via email after today's event. We appreciate you joining us and thank you for choosing to participate in today's program.